Hi friends, this is the third of the videos I'll be uploading with respect to the bank audit, bank branch audit in fact, for the financial year 2021. The last one we uploaded was relating to the IFC reporting, and that was on Friday, and today, 3 days later, I should have done that earlier because I think a fair number of members, they've already started the audits at the branches. COVID took its toll. I tested positive, and hence delay of 1 or 2 days. Today, what I'm planning is we'll take up the RBI circulars which have been issued during the current year, which are relevant to the branch audits. And, instead of taking the entire RBI circulars in one presentation, what I'll do is I'll, break it up and, I'm breaking it up into two different sets. Like one, you would have the COVID-19 resolution circulars, which the RBI issued during the year, and the other would be the other miscellaneous circulars which are relevant to us. So quickly, I'll give you the disclaimer. Like like in all my presentations, let me clarify that whatever I'll be speaking in this presentation of mine, they are purely my views and should not be construed to be views of either the ICI or my firm, and also they should not be considered as a professional advice. So let's quickly look through, which are the circulars which the RBI issued. Of course, the RBI issued a total of, if you go to the RBI site, a total of nearly 84 notifications. There were no master circulars or master directions which came in during the year, but the circulars, notifications, FAQs which came in during the year, I think there were 84 in number. I may be, incorrect by 1 or 2 numbers here and there. So what I've done is, I listed out circulars which would be relevant to us during the branch audit. And in the current presentation, what I'll do is I will take up the circulars which are relevant for only relevant to the resolution of stress, which RBI issued a number of them. Of course, so if you see this, there was one very important circular which came out on the 6th of August 2020, which related to the resolution framework, related stress of personal loans and other loans, and also a circular which was issued on the same date again, but this related to the MSME sector. So I'll take up these two circulars, and then also another circular where the RBI kind of relaxed the financial parameters when the banks would be sanctioning the resolution framework or the restructuring of such stressed assets. Of course, if you remember last time, the first video I uploaded with respect to the Honorable Supreme Court order, there, the RBI on the 26th of October, they came out with this circular where they said that, the ex gratia payment of difference between the compound interest and the simple interest for the 6 months had to be refunded or adjusted in the loan with respect to all borrowers of 2 crores and below. But now, of course, post the Supreme Court order, this gets extended to all the borrowers wherever they had opted for the moratorium. Now, let's quickly look through what are the chain of COVID relief circulars which came out. Once in 2020, in fact, friends, please remember that when one is identifying NPAs during the year, or when you try and see whether the resolution of stressed assets is as per the RBI norms, you would probably have to also go back to the earlier year of financial year 2019-20, because in all the COVID relief circulars there is you need to go back up to at least the first quarter of the previous year, 1920. So quickly, the 27 March circular, it gave us the moratorium to all the borrowers for a period of 3 months from starting from 1st March to 31st May. Then on the 17th April, the RBI said that, the accounts which were standard on just a day below the moratorium period starting, that is 29th of February 2020, would not be downgraded. And then since COVID did not relent, it continued to rise, the cases continued to rise. So on the 23rd of May, a further moratorium of 3 months was given from the 1st of June to 31st of August. Then, of course, the all-important 6th August Resolution Framework Circular, which we will discuss. And on the 3rd of September, the Supreme Court order came out where, you could not, no bank could declare account as an NPA post 31st August, that is from 1st of September. And of course, on the 23rd of March 2021, the blanket ban on the NPA was lifted, and the waiver of interest on interest, the compound interest was also, as per the order, is to be refunded and or adjusted in the installments of the borrowers. Now let's look up the circular relating to normal loans, not the MSME loans of the 6th August. Now this circular, which was issued by the RBI, this is one of the rare circulars where it applies to literally all the financing institutions. Normally, one would see that, when you look at a circular, you would see that, they're all relating to normally commercial banks or maybe RRBs separately, but here it relates to every lending institution. And it also, since, a number of our members also do NBFC audits. So, please note that, this circular would also apply to the NBFCs. Now, the 6th August 2020 circular of the RBI, now it has 4 parts, Part A, Part B, C and D. What is most important for us as branch auditors is the Part A, B, C. Now, Part A requires, it relates to specific resolution framework of relating to personal loans. Part B relates to all other eligible borrowers. And then Part C relates to the prudential treatment of the exposures in respect of which, you have a resolution plan either in Part A or Part B. And then, of course, Part D is the disclosure requirements, which, most probably would relate to the disclosure requirements to be made at the head office by the SCAs and not by the branch auditors, unless, of course, the branches have been instructed to compile this information, get it certified by the branch auditors, and then probably it's compiled at the zonal and head office level. Now let's quickly look at, this 6th August 2020, which what is it not applicable to? What is it? Which are the entities which are not eligible? As you can see, the MSME, farm credit, because MSME specifically because you have a separate circular of the same date. And then, of course, the financial service providers, housing finance companies, central government, state government, municipal corporation. All these, my idea of recording these videos is to give you an idea of, a macro view of the entire RBI circular. And maybe I do not get into too much micros, but then so that, you can post this, you can look into the video and, look into the circular and get into the micro portions of the circular. Now the circular actually, see, if you, there was a circular of the 7th June 2019, which came out in the FY 2019, where it related to, where it gave you a framework of a principle-based resolution framework for addressing borrower defaults. But at that point of time, the RBI had only made it applicable to aggregate exposures of 1,500 crores and above. And for less than that, the RBI had said that we would do it subsequently, which of course never happened because of COVID. Now, if you remember post, as per the master circular of 1st July 2015, Now, any concession on account of a financial difficulty obviously entails an asset classification downgrade, because earlier you had these where if you satisfy a few conditions post restructuring, one could continue with the standard asset classification of the account. But then now post 1st July 2015, the general thumb rule is that any asset class, restructuring one makes, it has to be downgraded unless unless it is a change of ownership or specific conditions like natural calamity and a few other, like the DCCO portion of the master circular. So the thumb rule for any resolution framework, unless there is a specific framework of the RBI, is that an account has to be downgraded to a substandard or a substandard account as soon as a concession is given, which falls into the definition of restructuring as per the RBI circulars. Now, this circular clearly says that this resolution framework has been given only for borrowers which are faced with stress on account of COVID-19. So one should not find that the branches are kind of window dressing or maybe sheltering normal borrower accounts which already had stress earlier under this, and then giving a resolution framework under this. I mean, this has to be, the stress has to commence because of COVID, and only then one can give restructure the account under this circular. Now, the basic intent of the circular is to mitigate the impact of the COVID-19, and of course lend them a resolution plan, and also to ensure that even without a change in the ownership, one can retain the standard asset classification in the account. So obviously no borrower wants that once my account is restructured as per the resolution plan, should it be downgraded? No, and not even the bankers would want that. So only to with that purpose, the RBI said that for those borrowers which have a financial stress on account of COVID-19, and if they are resolved as per the conditions under this particular circular, the account can be restructured and without downgrading the account as a substandard account. Of course, subject to specific conditions which we will see subsequently. Now here, it's while understanding this particular circular, please understand that there are a few dates which we have to remember. The reference date for the outstanding amount of the date which you need to remember is the March 1, 2020. So maybe you can in your checklist note this down, that for resolution of framework during the year under COVID, the reference date would be March 1, 2020. So again, one would have to look for the status in financial year 2019-20 for allowing a resolution framework during the current year as per 6 March 2020. So the first date one needs to remember is the reference date, which is the outstanding amount of debt that is considered for resolution by either the sole bank or a group of bankers or a consortium of bankers as of the 1st of March 2020. Now let's look at the part A of the circular, which refers to the personal loans. Now the applicability is, it applies to, part A applies to personal loans sanctioned to individual borrowers. It does not apply to facilities which are given to own or personal staff. And now here comes the second date, which is the eligible borrowers are those which were classified as standard but were not in default for more than 30 days as of March 1, 2020. So as of March 1, 2020, it should not be a SMA 0 account. It should be an account where the outstanding or the default is not more than 30 days as of 1st March 2020, which I said earlier is the reference date. Now here the eligible borrower's account can continue to be classified as a standard till the date of invocation. Now this is so this would become say the second date which would be relevant to all of us while finding out whether the resolution is as per the RBI circular, because if the resolution is not as per the framework, the circular clearly says that one would need to downgrade the account to a substandard account. So for us to allow the account to be retained as a standard account, the date of invocation is the date on which me as a borrower and the lending institution agree based on whatever projections and other things I give to them, that the resolution plan I can agree upon. Now here the third thing which we as branch auditors need to remember is the resolution under the framework, whether in part A or in part B. In both the cases, the RBI says should not be invoked later than 31st December 2020. So the first date becomes the reference date, which is the March 1, 2020. Second, for a borrower to be eligible, the default should not be for more than 30 days as of March 1, 2020. Third, the invocation date should not be later than 31st December 2020. And invocation, like we said, is the date when, for the outstanding, the borrower and the lending institution agree that, let's get along or let's go ahead with the resolution plan. The fourth date is the date of implementation, which is in case of part A, which is the resolution of stress for personal loans, is 90 days from the date of invocation, which happens to be the 31st of March 2021. So in all cases of personal loans, during the current year's audit of 2021, one would have to see that it is implemented as of 31st March 2021, or else, since it will not be implemented, you would have to downgrade it to a substandard account. That is, the resolution fails and automatically not being implemented up to 31st March 2021, one would have to not allow the account to be retained as a standard account, right? Quickly, number one, the reference date, 1st March 2020. Second, eligible borrowers, default not to be for more than 30 days as of March 1, 2020. Third, date of invocation, which in both the cases will not be later than 31st December 2020. And fourth, the implementation date in case of personal loans has to be within 90 days of the date of invocation, which obviously can be earlier than 31st December 2020. And if it happens to be on 31st December 2020, then it will be 31st March 2021. Now the resolution plan, the circular goes on to give you the conditions when I can treat an account to be implemented. That is, of course, it is, these are the three conditions. But what is more important to see is, other than the documentation being complete, we have to see that the borrower, as on the date of implementation, is not in default. So let's say I have the invocation on 31st December and I implement it on the 30th of March 2021. It should not be in default as per the revised terms which we agreed upon for the resolution. Now again, to remember, and that if the resolution of personal loans is not implemented by 31st March 2021, or any of the conditions of implementations are not implemented in terms of the current circular, the account has to be downgraded as an NPA as of 31st March 2021. So friends, this was about part A. Now let's get on to part B, which relates to all other borrowers, eligible borrowers, which are not covered in part A. Now here again, the eligible borrowers is exactly the same, that is, which were classified as standard, but were not in default as of 31st March 1st March 2020 for a period of more than 30 days. This is exactly similar to the condition in Part A of the circular, and the account should, here it says it should continue to remain as a standard account till the date of invocation. Now here, because it is not a personal loan, you could have a case where it is a sole banker. Now if it is a sole banker, then obviously where the date of invocation would be the date when the borrower and the bank or the lending institution agree upon a resolution plan as per the board approved policy. That's fine. Now in a multi-banking institution or a consortium, the circular goes on to say that one, as a branch auditor, you would need to see that the invocation is agreed upon by 75% of the lending institutions by value, that is fund based and non-fund based, and not less than 60% of the lending institutions in terms of number. So if both these conditions are satisfied in terms of a multiple banking institution or a consortium, one would go ahead. Again here, I think the resolution invocation date is exactly the same, like I said, 31st December 2020. But in case of a resolution of other than the personal loans, the circular gives us a time of 180 days from the date of invocation. So here the critical date becomes 29 June 2021. So obviously, you friends, when you go out for the branch audit, you would find a number of cases where probably the resolution plan has been invoked by 31st December 2020, but the implementation is still pending. So if that be the case, you'll have to take it as on record, since the critical date here being 180 days from the date of invocation would be 29 June 2021, unless of course the date of resolution is post 6th August 2020 when this circular came out, and 180 days period falls before 31st March 2021. You'll have to do a mathematical calculation for this to arrive at the final implementation date, which is critical for retaining the account as a standard account. Now, here again it says where the resolution has been invoked, but lending institutions representing 75% and 60%. Now here, if it is a multiple banking arrangement or consortium, then if the 75% by value and 60% by number, if they do not sign the ICA, which is the inter-creditors agreement, within 30 days from the date of invocation, the invocation will be treated as lapsed. Hence, there's a very important point to be noted here, that you need to ensure that the ICA is signed within 30 days of the date of invocation. And in respect of such borrowers, also the circular says the resolution process cannot be invoked again. So let's say once in a multiple banking arrangement, the invocation date was 1st of December, and the lending institutions could not sign the ICA within 30 days, say by 31st December or the 1st of January, then number one, the invocation would be treated as lapsed. So obviously, you would have to downgrade the account. And secondly, in all respect of all these kind of borrowers, you cannot invoke the resolution process again. So once in a lifetime is the opportunity which the circular talks of. So if any of the timelines are breached at any point of time, then the circular says that the resolution process would cease immediately in respect of the borrower concerned, and in terms of the extant prudential guidelines for July 2015, you would have to downgrade the account as a substandard account, except of course in respect of change of management, etc., which are specific conditions given in the circulars. Now, the asset classification and provisioning. Now, what happens in case of an additional finance? If it is sanctioned before the date of implementation, that is the 31st of March or the 29th of June, or 90 or 180 days from the date of invocation. And now in this case, the additional finance can be classified as a standard asset till implementation of the plan, regardless of the actual performance of the borrower. So whatever the borrower, whether he's paying or not paying, I would have to classify that particular account as the additional finance as a standard asset till the date of implementation, which in personal loan, the last date is the 31st of March, and in other borrowers, it is the 29th of June 2021. Now, if the resolution plan is not implemented within the stipulated timelines, the timelines I gave you, so the asset classification of the additional finance will be as per the actual performance of the borrower with respect to the additional finance, or the rest of the credit facilities, whichever is worse. So, you'll have to compare that and then classify the account accordingly. Now, if a resolution plan is implemented in adherence to the provisions, the account will be classified as a standard. It can be retained as standard upon implementation, and the borrower's account, which probably has slipped into an NPA from the date of invocation till the date of implementation. Now, on the date of implementation, if it is within the timelines as prescribed by the RBI, I can upgrade the account as a standard account. In respect of personal loans, where a resolution plan is implemented, now the lending institutions shall keep the provision from the date of implementation, which are higher of the provisions as per extant norms, or 10% of the renegotiated debt. Now, friends, I think, for your understanding, it will be better if you go through the circular with respect to the provisioning norms, etc., so that, when you actually see these kind of cases in the branches you are doing, you can compare it with the circular and ensure compliance. Reversal of provisions also, there is a provision in the RBI circular. Broadly, what it says is, in respect of both the personal loans and the other borrowers, what the circular talks of is, half of the provisions needs to be written back upon repayment of 20% of the residual debt without slipping into NPA, and remaining half is written back when the borrower pays another 10% of the residual debt without, of course, retaining the standard category. Yeah, this is in respect of personal loans. Similarly, if you see in respect of the non-ICA signatories, well, half the provision may be reversed on repayment of 20%, other half on another 10% of the carrying debt, subject to, of course, the IRAC provisions being maintained, which is normal. Now, what happens post implementation? Now, this is an important slide which all of you need to have a look at. Now, for personal loans, after the implementation date, that is the 31st of March 2021 or the 29th of June 2021, I am taking the last dates and not the actual date, which obviously, friends, can be earlier to that also. So, for personal loans, after the implementation of the resolution plan, then the subsequent asset classification will be governed by the extant prudential guidelines, which obviously would be normal if they do not the delinquency 90 days delinquency norms. If it is not there, you write it down as a substandard account. And in respect of other exposures, part B ones which is other than personal loans, then any default by the borrower with any of the signatories to the ICA during the monitoring period, it shall trigger a review period of 30 days. So, let's say it is a normal borrower and the borrower defaults during the monitoring period, then a review period will be triggered off for 30 days. Now, what is the monitoring period? If you look at the bottom of the slides, it clearly says that, it is the period when the date of implementation commences, which is the date of the 31st March 2021 or the 29th June. Suppose that one day after that, till the borrower pays 10% of the residual debt, and subject to a minimum of 1 year from the commencement of the first payment of interest principal or the credit facility with the longest period of moratorium. So, if the borrower defaults during this period with any of the signatories, the multiple banking arrangement will have to trigger a review period of 30 days. And if the borrower is still in default with any of the signatories to the ICA at the end of the review period, which is 30 days, the account then will have to be downgraded to NPA from the date of implementation in respect of all the borrowers or the NPA classification which was there. Now, let's say I classified a substandard account under the resolution framework, then it would be, the NPA classification prior to implementation, and of course, you'll have to add the current, the period which is elapsed as per the extant prudential guidelines. These are the disclosure requirements which are given in the RBI circular. So like I said, I'm not sure whether these disclosure requirements are for compliance at the branch level or the head office level. This, of course, there's only a compilation process which one can do. So this was about, the main RBI circular of 6th August 2020. Friends, please do download this circular and have a look at it. And in case if you have any doubt on that, please do send me a WhatsApp message. As of date, I am not responding to WhatsApp messages through text messages. I would prefer, if I do get a issue from you, I would send you a voice note, which is, easier for me to send you a resolution or, whatever my understanding is of that particular issue. Now, the second circular, which came out on the 7th September, I'm not taking up the MSME circular of 6th August 2020. This is basically about relaxed, financial parameters for the resolution framework of COVID-19. So, you can have a look. It basically gives you a, much more relaxed financial parameters to allow, or, they've kind of fixed these ratios for allowing the banks or the lending institutions to give a resolution to the stressed assets as per Part A and Part B. 6th August 2020, there was another circular which, of course, like I said, referred to the MSME circular. This is very similar to, the MSME circulars which came out earlier. Now, here also, you are allowed to retain the account as a standard account without a downgrade as per the prudential guidelines, subject to, conditions being complied with from condition 1 to 6. So, the first condition is the aggregate exposure of fund-based, non-fund-based has to be less than equal to 25 crores. Here again comes the reference date, which is March 1, 2020. Number 2, here in respect of MSMEs, the borrower's account has to be a standard account on that date, which is March 1, 2020. So, friends, like I said, one would have to go back to the earlier year and then find out whether it was a standard account as of that date to actually ensure compliance with this particular circular. And the restructuring here has to be implemented by the 31st March 2021. So effectively, for Part A, which is the personal loans, I have to ensure that the restructuring is implemented up to that date, else I need to downgrade. And similarly, in respect of MSME accounts, I'll have to ensure restructuring up to March 31, 2021, otherwise else I'll have to downgrade. The other 3 conditions are, number 1, the borrower has to be GST registered unless they are not, exempt as per the exemption limit existing as on March 1, 2020. Then, the asset classification can be retained as a standard account. Of course, the main advantage of both the 6th August 2020 circular for both the borrowers and the lending institution is that one can retain the standard asset category. But however, this MSME circular refers to that, in case the assets, the accounts slip into the NPA category between 2nd March, which is, one day after the date on which it is supposed to be standard, 2020, till the date of implementation, which is 31st March 2021, the account can be upgraded up to on the date of implementation. So let's say, 2nd March and in between it gets downgraded to a substandard account, but however, it is implemented on the 29th of December 2020. then it has to be upgraded as a standard account in terms of this circular. But of course, the restructuring has to be specifically as per the terms of this particular circular. And then this circular talks of an additional provision of 5% over and above the provisions already held. So this was the circular relating to the MSME. So friends, that was about all the two important circulars for the resolution framework which the RBI took out. Like I said, please feel free to write to me or get in touch with me, text me on WhatsApp maybe, and in case you have any issue with respect to the understanding of these particular circulars, and in case you do find that what I've explained in respect of these circulars, you have a different understanding, please also write to me so that I can correct my own understanding. Thanks a lot, friends. Bye bye. See you. Stay safe, and I'll be in touch with you for the next few videos where so that I can try and cover most of the topics which you would be faced with during your branch audits. Bye bye. Thank you. See you.